You voted against cutting rates in July. A month from now, if the data come in about as they have been, would you vote the same way?
Well, we'll have to see, and I never pre-commit to my decisions until I hear the discussion around the table, take in the data we see. But to the extent that the economy unfolds, as I've expected, I didn't see in July that interest rates were going to solve for some of the issues that might have been affecting things.
Can you see at this point any scenario in which the committee, though, would not cut rates?
Where I'm focused is on how are we performing relative to our mandates. So when I look at where unemployment is, when I look at where inflation is right now, I think we're in a good place as long as the consumer can continue to pull the economy forward. Obviously, we have some weaker segments in our economy, but to the extent that our forecast of growing at around 2% holds, then I think we're okay.
Well, there is a feeling that to a certain extent there's a third mandate for financial stability. If you don't cut rates, we could see a market tantrum as we saw in December. Does that concern you?
That could happen, but there are also financial stability concerns on the other side. Easing policy is not a free choice. It, remember, pulls forward demand. It can make leverage more attractive. And I think, depending on where you think you are in the business cycle, it can create more risk. So, again, our mandate focused on unemployment and price stability is probably the best place to focus in my view right now.
Well, tell me what you're seeing in your district and what business leaders there are telling you.
So business leaders express a fair amount of uncertainty and concern about knowing where export markets are going and what their opportunities are going to be. On the whole, though, they continue to be optimistic about the outlook for the economy. And that, again, I think is premised on a consumer that is experiencing wage growth, has a safety net of savings behind them, and remains confident. I think if any of those change materially, that could change what we're hearing too.
But you're not seeing any signs of weakness at this point?
Not yet. We saw the consumer confidence numbers slip back a little bit, and again, not surprising given some of the headlines and concerns about market volatility. But I think between now and the time of the next meeting, we have a number of data releases that will be good barometers for us of where the economy is.
Do business leaders tell you that they feel there's some pent-up demand out there that if the uncertainty went away would lead to higher spending?
I think a number of our businesses have put some plans on hold. And so I think to the extent they see more clarity, they see opportunity, they may move forward with those. Again, I think not knowing when that might happen has caused them to hold back a little bit.
But is that a problem monetary policy can solve? Is the cost of capital anything that's figured in their decisions to go on hold?
No, I think it's a very important point. And those business contacts will tell us our problem is not the cost of credit right now. And monetary policy cannot resolve the uncertainty that's holding us back.
Well, do you think the Fed is acting because it's basically the only game in town?
Well, I think central banks in general have been pushed to the forefront around doing what they can. And of course, central banks should do what they can and do what's appropriate. I think for me, as I look at where the economy is, it's not yet time. I'm not ready to begin to provide more accommodation to the economy without seeing an outlook that suggests the economy's getting weaker here.
Well, hiring has slowed. It's still healthy. Are companies struggling to find workers at this point, or are they cutting back or limiting their hiring because of the uncertainty about where the economy is going?
So the reports we get so far are that businesses are still having a hard time finding people. They are still wrestling with wages and thinking about how to compensate a workforce that they need to be productive. So I think that still is one of their largest concerns, is keeping the workforce they have and figuring out how to compensate them in a way that will keep them.
Well, you know, my next question is going to be, where is that wage pressure that we should be seeing that you've been looking for so long?
So I think we are seeing higher wages. It's true that for a number of years, even as the unemployment rate came down, we were not seeing a pickup in wages. I think over the last couple of years, you have seen that pickup. And I think as productivity has gotten stronger, so the recent releases around that suggest that inflation is not going to pop up in a way that will undermine the workers' ability to realize some gains around that wage growth.
Well, then let me ask you about how you look at monetary policy, because you were an advocate of raising rates to get ahead of inflation. If you're not ready to cut rates, are you happy with where rates are, given that inflation is lower than anticipated? And would you be happy to leave them at this level for quite some time?
So I think that's going to be a process of judging how the economy unfolds. So I think where rates are right now relative to the unemployment rate and inflation suggest we're at a sort of equilibrium right now. And I'd be happy to leave rates here absent seeing either some weakness or some strengthening, some kind of upside risk that would cause me to think rates should be somewhere else.
Where would you put the neutral rate right now relative to where you are? Are you tight? Are you loose? Accommodative? How do you see it?
So I would judge policy to be at neutral or even accommodative with this last rate cut. If you think about where real interest rates are relative to the rate of inflation and where the Fed funds rate is, we're operating close to zero with real rates. I can't believe that that is tight in any sense for the economy right now.
Would you push back against the argument then that the December rate increase was a mistake on the Fed's part?
So I think in my public speeches, my view was we were beginning to see mounting downside risk at that time, and that those were beginning to have some concern about the outlook. It influenced my outlook in terms of flattening a path of policy at that point. But I think as we've judged over the last 2 quarters, the economy has continued to grow, and I think the economy has absorbed that. So,
well, if you're not ready to put more accommodation into the economy, but you don't want to pre-commit, would you be able to say that you would definitely dissent on a 50 basis point cut like the markets are calling for?
I don't see a case for a 50 basis point cut today. But again, I'm mindful in these decisions, you're making judgments about how you read the data up until the time of the meeting. And importantly for me, I use that meeting to listen to my colleagues, to hear what their arguments are, how they weight some of those risks. So it's always difficult for me to prejudge where I will come out until I get into that meeting.
Do you think markets are looking at the economy rationally these days?
I don't know. I'm not in the markets to know what those judgments are. I think markets see how the rest of the world is slowing. I think uncertainty never plays well in the markets. So I understand why you see fear and uncertainty right now. That isn't the metric, though, that I feel we have to focus on. We have a clear mandate, and I think a long-term view that we have to stay focused on.
Agriculture is big in your district. Farmers have complained that with the trade wars, they can't sell. Prices have gone down. Yet at the same time, the administration is using the extra taxes we're all paying in tariffs to compensate the farmers. So are they badly off, or are they making it through okay because of these payments? What's the real story with that?
So farmers began to experience a real hit to their incomes going back before the tariffs. Commodity prices for grains came off in 2014, so we're now into a 5th year of low farm incomes. That certainly stresses that sector, but by and large, those farmers are not leveraged as they may have been in past cycles. They would much prefer having outlets for their product as opposed to subsidies coming in for that. So I don't think it's an even substitution for them. But I think they're going to continue to struggle until the price of their commodity moves up.
I know you would tell me that the Fed is not influenced by politics. You go into the room and you put all that aside. You don't listen. But it's every day now. Is it tiresome?
So I'll tell you, you have to be focused on what your job is. And you have to understand that an institution like the Fed, as many other aspects of our government, is built around checks and balances. So I have the ability to think about, with complete accountability to Congress for our mandate, being transparent about my own views, to focus on what serves the American public best. And I think what serves them best is for the committee to remain focused on how do we achieve maximum employment and stable prices for the public. And I feel good that that's where the committee is focused.
One last question. the data aren't that bad, growing 2% or so, 3.7% unemployment, inflation somewhere between 1.7 and 2%, very close to your mandates.
Right.
And yet Wall Street has started to price in the idea that you've got to cut because we're going into recession. Can we talk ourselves into recession?
Well, there are any number of things that can unsettle confidence in the economy. And we've seen past periods where fear and uncertainty could affect the economy. And I think I'll be watching that to see whether those kinds of concerns spill over into how consumers are spending, can further impede business investment, exports, and other things. So always mindful that those downside risks could materialize in some way, but not preempting until you see how it may spill over.